Hey everyone, I'm Professor Franklin. Today, we're going to discuss an important question for investors. What happens to your investments when a major geopolitical conflict begins? Imagine tensions between the United States, Israel, and Iran escalating into a military conflict in the Middle East. Such a conflict would not only affect governments and militaries, it would also affect global financial markets. Oil markets, stock markets, currencies, and commodities could all react within hours. For investors, understanding how to protect their money during these situations becomes extremely important. So today, class, we're going to examine how investors respond to geopolitical shocks and what strategies they use to protect their portfolios. During a conflict involving Iran and the United States or Israel, financial markets often react immediately. The Middle East plays a crucial role in global energy production, and any military tension in the region can quickly influence oil markets. Because global markets are interconnected, investors around the world respond rapidly to geopolitical risk. Stock markets may open with sharp declines as traders react to uncertainty. Investors begin reassessing risk and adjusting their portfolios. During periods of geopolitical tension, volatility in financial markets tends to increase dramatically. This means prices move more sharply and more unpredictably than usual. Now, class, let's talk about stock prices. When geopolitical tensions rise, stock prices can fluctuate rapidly within very short periods of time. For example, during major global crises, the S&P 500 has historically experienced short-term declines of 5% to 10% within days as investors react to uncertainty. This does not necessarily mean companies have suddenly become less valuable. Instead, it reflects uncertainty about how the conflict might affect economic growth, energy prices, and global trade. Large institutional investors may begin reducing exposure to risky assets. This creates rapid movements in stock prices across multiple sectors. When uncertainty increases, investors begin looking for safer places to store their money. This behavior is known as a flight to safety. During geopolitical crises, investors often move capital into assets that historically hold their value during uncertainty. Examples include gold, government bonds, and stable currencies like the US dollar. These assets are considered more stable during periods of geopolitical risk. As investors shift money toward these assets, prices in those markets can rise. Short-term investors are often the most vulnerable during periods of geopolitical conflict. Because they focus on short-time horizons, sudden market movements can quickly generate losses. If markets fall rapidly during the early stages of a conflict, short-term traders may find themselves caught in unexpected price swings. Some investors attempt to exit positions quickly, but rapid price changes can make this difficult. As a result, short-term trading strategies often carry higher risk during periods of geopolitical instability. Volatility measures how quickly and dramatically prices move in financial markets. During geopolitical conflicts, volatility tends to rise sharply. The VIX index, often called the fear index, measures expected volatility in the U.S. stock market. During major global crises, the VIX has historically surged above 30 or even 40, signaling high investor anxiety. High volatility increases risk for inexperienced investors. Prices may move dramatically in both directions within a single trading session. Without a clear long-term strategy, investors may make costly mistakes. Another common reaction during geopolitical crises is panic selling. When investors see markets falling rapidly, some may sell their investments out of fear. However, panic selling often locks in losses that might otherwise recover later. Financial history shows that markets often decline temporarily during geopolitical shocks, but recover over time as uncertainty decreases. Investors who sell during moments of panic may miss the eventual recovery. This is why emotional reactions can be one of the biggest risks in investing. Now, class, let's discuss psychology. Financial markets are not driven only by numbers. They are also influenced by human emotions such as fear, uncertainty, and speculation. During a potential conflict between the United States, Israel, and Iran, news headlines may change rapidly. Investors may feel pressure to act quickly, but emotional decisions often lead to poor financial outcomes. Successful investors typically rely on disciplined strategies rather than reacting impulsively to news events. One of the most important strategies for protecting investments during geopolitical crises is diversification. Diversification means spreading investments across different assets, industries, and regions. For example, an investor might hold stocks from multiple sectors such as technology, healthcare, and consumer goods. They might also hold bonds, commodities, or international investments. When one asset class experiences losses, others may remain stable or even increase in value. This helps reduce the overall risk of the portfolio. Diversification does not eliminate risk, but it can significantly reduce the impact of market shocks. During geopolitical crises, investors often increase exposure to safe haven assets. Gold is one of the most widely recognized safe haven investments. For thousands of years, gold has been considered a store of value during times of economic uncertainty. During geopolitical conflicts, gold prices often rise as demand increases. Another safe haven investment is U.S. Treasury bonds. Because they are backed by the U.S. government, they are generally considered low-risk assets. As investors move money into these assets, they help stabilize portfolios during periods of market turbulence. Another important strategy is maintaining a long-term perspective. Financial markets have experienced wars, recessions, and global crises throughout history. Despite these challenges, markets have generally grown over long periods of time. Investors who maintain long-term investment strategies often avoid the mistakes associated with emotional trading. Rather than reacting to short-term market movements, they focus on long-term economic growth and corporate performance. This approach helps investors remain calm even during periods of geopolitical uncertainty. So, class, what is the main lesson from today's discussion? A conflict involving the United States, Israel, and Iran could create significant volatility in global financial markets. Stock prices may fluctuate, energy markets may react, and investors may feel uncertainty. But experienced investors understand that markets have faced geopolitical crises many times throughout history. By diversifying portfolios, investing in safe haven assets, and maintaining a long-term perspective, investors can reduce risk and protect their financial future. Understanding how markets behave during crises allows investors to remain calm and make better decisions. And that, class, is one of the most valuable lessons in investing. I'll see you in the next lesson.